Where are we going from here?
So I do think that the Fed is it's a headwind, and doesn't seem like things will get much easier there in the coming period. On a slightly more positive note, I do think China reopening is definitely getting a bit of a buzz and maybe helping a bit global risk sentiment. So I do think that's playing a role. Positioning still, for the most part, remains pretty low, and you could see a bit of pickup in buybacks. We're coming out of the buyback blackout period, and for some of the sort of reasons around the Inflation Reduction Act, companies may look to, move some of their 1Q buyback activity to now 4Q. So I think that could help the market in the short term as we go into December. But the bigger question, I think, remains 2023, and specifically around earnings and how much potential slowdown we see there.
But you don't see as much slowdown in earnings as some of the more dire forecasts are suggesting. You revised it lower to 225. That's still pretty darn good, considering where some projections have moved closer to $200. How do you justify that?
So, look, we revised it lower. We were at 240. Consensus in the meantime, I want to say last few weeks has come from about 240 to now low 230s. So, yeah, 225 is calling for basically flat growth. We still see top line expanding next year. We see some margin, compression, but not significant. So, again, I think it depends on how central bank policy continues to evolve. The dollar effect, how that evolves. Labor market, I think, is extremely important because that continues to drive pricing power. So if labor market next year really starts to contract, I think pricing power is going to start cracking, and then I think margins come under bigger pressure. So 225, if I had to sort of argue upside versus downside risk to the number, definitely downside. But we're basically looking to gather some more inputs before eventually revisiting that.
So, Shan, you got a couple of issues that we got to contend with, certainly as it relates to today's jobs report. You could say, okay, the labor market is probably still hotter than the Fed would like it to be. But then you could also, I think, make the statement that, well, they've raised 300 basis points in 6 months, and the economy is kind of hanging in there pretty well. Adding a lot of jobs, it's pretty resilient. It shows you the level that we started this whole journey at, which was a pretty high economic base. So it's okay, the Fed has done a lot. We still have to wait a little bit to see it fully get through the system. But the economy is holding up well enough that maybe in some corners there's the view that they can actually pull this off, that they're not going to put us off the cliff, that they can somehow land the plane softly. However, some people want to suggest that that's nearly impossible at this point.
Well, I think it's your definition of soft landing. I think that the expectation of that we won't see an economic contraction, even if it's shallow for a couple of quarters in late 23 and early 24. Our view is that is likely the soft landing scenario. I think a soft landing that foregoes recession entirely, I think is going to be very difficult given the rate hikes that you spoke of and the fact that we haven't seen that transmission. So if you look at what's happening in the job market, month over month, wages up 0.4%, year over year 4.7%. That is the stickiest form of inflation, Scott, as we know. And so that still has to be factored in over the course of the next year or so. And if you think about the pricing power that some of these companies have been able to continue to exert in terms of the inelasticity of the demand that the consumer is experiencing, like you look at Expedia's results, for instance, it is continuing in the services sector. So the hiring that we're seeing is in services. That's where the demand has continued. That is where we see pricing power for the most part. We're starting to see that deterioration on the good side. You're starting to see deterioration in tech spend. Concerns about the potential backlog that we see for these tech companies not materializing. So we are entering into a slower growth environment next year. I think the Fed has done a lot. I don't think that we have the full transmission. I disagree with Steve that we're going to see continued restrictive policy from the Fed in the second quarter, because I think we're going to see meaningful improvement in producer prices, and that is going to start to trickle down. But if people are sitting here thinking that when we talk about a potential soft landing, that implies a scenario where the U.S. economy does not contract, I think that that's probably a little bit too optimistic.